What is a mortgage rate lock? When can you actually lock your rate? What goes into locking your rate? What happens if rates improve? What happens if your rate lock expires? Well, that's exactly what we're going to dive into in today's episode. So, Josh, this podcast is really coming to light because of the questions that you often get when working with potential buyers, in really any type of environment, but right now, just because rates are so volatile. So why don't we spend a little bit of time and talk about, what a rate lock is and the importance of why we're talking about today's episode.
Absolutely. It's one of the more misunderstood topics inside of mortgage finance. Everyone has an idea of what a rate lock is, but a lot of misconceptions around it. So at its basic, most simple form, the rate lock is an agreement between you and the lender to close your loan at a specific interest rate for a set period of time. So the benefit is pretty obvious, right? Gives you peace of mind that you don't have to worry about those day-to-day fluctuations. You said something really important. It's really about the volatility is why you want to be protected from a lock. Most escrows are 30 days. Some are a little shorter, some are a little longer. But whether we're in a 40-year bull market where interest rates go down, whether we're in a 2-year bear market where interest rates have gone nowhere but up, within any 30-day period, you get a lot of volatility. In that downtrend, we can have a spike up in rates. In the uptrend the last 2 years, we've had 2 or 3 little blips where we've had an opportunity to recognize and realize a lower interest rate. So because of that, with affordability strain, interest rates are really important, and locking that rate and making sure you get the best terms and securing your pre-approval is really important. So that's why we want to go through all this today.
No, it's important. I mean, your mortgage payment, the interest that you pay is based off of that interest rate. So, when you're having that conversation with a mortgage lender, a lot of times up front, you're just getting a quote and you have no certainty as to what the actual rate that you're going to take home is until it's locked. And there's this misconception out there that, hey, I've talked to Josh. Josh told me that interest rates were going to be 7%. So that's what I build in my head. That's the payment I build in my head. And then guess what? The market changes, volatility happens, the Fed comes out and does something that was unexpected or didn't do something that was expected. And now that 7% rate is 7.25% in some cases. Or maybe you're on the flip side and it's 6.875 and things are much better. But I think it's important to kind of dive into this. But let's talk about lock period, Josh, kind of to start off the episode. What would you say the typical lock period for someone coming in and locking a loan is?
So generally, all lenders offer lock periods in 15-day increments, 15 days, 30 days, 45, 60. After 60, some will go to 75, but you'll see 90, 120, 150, 180. And not all lenders offer anything longer than 60 days. Pretty much everyone has 60 and shorter. Most, but not all lenders offer those long-term locks, and we'll go through some of those details with it. That being said, there are a few lenders here in the last few years who've said, hey, we'll let you price in 1-day increments. So we can look at a 10-day lock, a 9-day lock, a 17-day lock instead of a 30 if you only need 17 days to get you to closing. And why might that be important? A guest we had on in the fall, Jeb, Barry Habib, is famous for saying there's only 3 things that can happen to your interest rate during your escrow period, and 2 of them are good. The one that's obvious is if rates drop, hey, that's great for me as long as I have not locked. Rates can stay flat, and that is also good for me. And why is that? It's this lock period that we're talking about. The shorter a period of time that you lock for, the better the pricing is. Now, is it a huge difference between a 30-day and a 15-day, or a 15-day and you have a lender that will let you lock for 8 days? Not a huge difference there, but in this strained affordability market, every little bit of that counts. And the obvious thing that is bad is if rates go the wrong way. So that's what we're talking about today, is locking interest rates and protecting yourself from the chance that rates go higher during your escrow period, which can actually invalidate your approval. A lot of people are really tight on their ratios. If you don't lock and rates spike 0.5% over the course of a week, you may no longer be approved or have to buy your interest rate down, pay points to get that same interest rate that was your max for your qualifications.
So let's transition and talk about considerations of locking your loan. Who should lock a loan? Who should float, right? Because, every day you subscribe to a service. So, and every day uh, that particular service comes out and says, hey, Josh, based on what the market's doing at the moment, we recommend that you lock all of your current loans, or we recommend that you float your current loans. So maybe explain locking and floating, so the general terms, in layman terms, if you will, and then talk about really who should consider which direction depending on what type of person they are.
Absolutely. So we covered what a lock is. It's the lender guaranteeing or assuring you that if you close by this date, this is what your interest rate is going to be at these terms. Floating is basically the absence of that guarantee. You're saying, I will subject myself to the market whims. If the market gets worse, I'm going to deal with that. If the market gets better, awesome for me. So we just went through that 2 out of the 3 things that can happen are good. Only one is bad. So what this comes down to in terms of making that decision is, what is your risk tolerance level? So like the easiest way that I like to ask people when we're having this conversation, are we going to lock or are we going to float? Say, the airplane hits the ground in Las Vegas. Are you the person that jumps off the plane and can't get money into the slot machine at the airport fast enough? If so, you're a gambler. You're probably open to some risk. If you're the person who is not going to gamble the whole time you're going to see some shows. You're going to go to the buffet. You're going to go to the mall. It sounds awesome. You're going to have a great time and you are never going to gamble a dollar. That tells me that you have a very low risk tolerance. So kind of going back, you said we have a service. You and I have a service we both subscribe to. I have 3 others. Now, when all of those people, they all happen to be men, but if all 4 of those guys are saying the same thing, lock or float, we can pretty safely say the consensus is that we can lock or float. But the reality is they rarely all agree. And they also have multiple timeframes. When they're advising industry experts or industry participants, Jeb, Josh, they're saying, hey, in 3, 4, 5 months, rates might be here. You don't care if you have to close in 21 days where rates are going to be in 3 to 4 months. So we kind of have these 2 forecasts of what happens for clients who are under contract right now, what happens for industry participants that need to know what's coming up. And when we're talking today, and that lock float decision largely comes down to what is happening in the next 1 to 3 weeks with interest rates.
No, and we're going to get into some of the questions that a lot of you guys have about, what it costs to lock, what happens when it expires, what happens if rates go down. But before we do that, I'd like to take a minute and ask a favor. If you find any value in our videos at all, do us a favor and hit that thumbs up. And if you want to stay updated on content like this, do us a favor and hit that subscribe button. And honestly, guys, we are always welcome and open to your, what you guys want to hear from us. So if there's something you want us to cover, comment below. We read the comments. We go over the comments. If there's something you want us to cover that we have not covered, please do so. Drop a link, drop a line below, let us know, and we'll make sure we get on it. So Josh, kind of want to transition here. There's, the questions that we're about to go through are really, the questions that you probably hear the most often, with one of the first ones being, what does it cost? What does it cost me to lock a loan? And with that, can you lock a loan with multiple lenders at the same time? Because it's going to kind of go along the same line here.
Well, those are 2 very different, similar but very different questions. And let me close the loop on the lock period also. If you say, hey, there's a 15-day lock and there's a 90-day lock, well, isn't 90 days better? Wouldn't I just choose a 90-day lock? That's more insurance. So it's important to know that you should think of this like life insurance. I'm 50 years old. If I want to buy a 10-year term life insurance policy, the insurance company will look and say, hey, most people live to 60. That's little risk to us. That's pretty cheap. Now, if I want to buy a 30-year policy and that puts me to 80, say, hey, there's a pretty good chance he won't be around till the end of that. And they're going to price that at a much higher premium. So the same thing, a 90-day lock, you're insuring a much longer time frame. There's a much greater cost to the lender. So with that, the shorter the lock, the cheaper it's going to be for you. So other things being equal, you would like to lock for the shortest period of time that you need. So you're not buying any insurance unnecessarily. And you also hinted at a piece that's really important. If you're calling around and you're shopping for quotes, we always tell you, make sure you're getting quotes on the same day. Don't call me on Tuesday and call someone else on Friday and go, hey, that person's rates are terrible on Friday. Rates might have shot up all week, or it could go the other way. You can't say, hey, the guy on Friday has great rates and Josh has terrible rates. Rates may have gotten better all week. Same thing here. Make sure you are getting a quote for a 30-day lock. If you're not under contract, 30 days is the most common, unless you think, hey, I'm going to get into a long escrow, or hey, I'm going to get into a real short one. Make sure that everyone is quoting you the same lock term, because it will impact your pricing.
Let's go into a real life story here, Josh. You told me a couple days ago, I'm kind of just throwing this on you. It's gonna come to you about somebody that called you on a Sunday and wanted to lock a rate or didn't want to lock a rate. So kind of go over that story, go over what the impact was because of that conversation. Because I think it's important to know when shopping lenders, not everyone is equal, first and foremost, but this kind of leads people into the direction we're going with the conversation and why it's really, really important to make sure you have a professional on your side when talking about this.
This was an interesting one. It's a listener to the show. They were going to be going with us, and we had talked about it. They were trying to shorten their lock period. So the lender, the investor that we were going to place their loan with, allows us to lock over the weekend with Friday's pricing. So we said, hey, let's wait till Sunday. That gets two less days of lock needed. Well, he spoke to another lender on Sunday who told him that's a lie. You can't lock over the weekend, which no one should ever call another lender a liar, because you don't know what each lender's policy is. There are absolutely lenders that will let you lock 24 hours a day, 7 days a week. They're the exception rather than the rule. So anything is possible. But within that context, they said, oh, and I didn't know you wanted to pay points. I would have quoted you that rate as well, and says, we can do it. I'm going to lock it in the morning and it'll be cheaper. Well, Monday morning came, and this volatility that we've been seeing over the last couple of years, rates were 3/4 of a point worse, half point, 3/4 of a point worse the next morning. So what do you know? The guy doesn't want to circle back and say, hey, that number wasn't really available. What can you do right now if we choose to lock it? Locks it with them, ends up an 1/8 higher in interest rate, a half point higher in fee than what we otherwise would have been. And that's just from literally, do we lock Sunday night at 8 p.m.?
So they didn't,
or do we lock,
in short.
They did not lock. Right. And literally the very next day, 24 hours later, it cost them an 1/8 in rate and a half in fee in dealing with two different lenders. Now, the interesting situation is I don't think the other lender was ever better than us. They're using simple sales text. Well, they can't do that. They can't lock that. I can do this too. But basically convinced him, go with me. I can't lock it till tomorrow morning. No risk. Well, there was risk. And we had already talked about why there was risk and why we probably didn't want to carry into Monday without being locked. Bigger picture issue there, Jeb, is that a lot of loan officers don't have an informed market opinion, and they will not advise you on locks, which if they don't have an informed market opinion, that's probably the better way to go, because I get crazy insights that people say, well, I talked to this person and they said we should float because of this, but they said we should lock because of this. And it is the craziest, most harebrained thing I have ever heard. So careful who you're taking advice from, including this guy, including Jeb, including anyone you find online. You have to come to this decision on your own using the information from the sources that you know and come to trust.
Now, and with that, Josh, there's one thing that frustrates me, and I'm not even in the mortgage business anymore, but it's when somebody gets a quote from, say, me, just hypothetically, say I'm a mortgage lender, and I quote you 7%, and I say it's with a point. And then they call you, and Josh says, well, I can actually do 6.875 with no points. And then they go, okay, well, I'm going to call Jeb back. And now Jeb says, well, okay, that guy's offering that. Well, I'll do that too. It's like, well, why didn't that guy offer that to begin with? And so it frustrates me when somebody gives the first person another opportunity, especially when it was on the same day that they got quoted. Now, if it was a week apart or 2 weeks, okay, I get it. There's a little bit of a difference there. But when somebody's comparing things and the first person wasn't able to get that with you wasn't able to give that to you because they weren't being honest and they were trying to overcharge you in fees so that they could make more money, and now you're giving them a chance, that pisses me off. It's like, why are you giving the person that was about to screw you another opportunity when they weren't doing that to begin with? Well, I'm stepping off my soapbox now, but just if you're out there.
Stay on the soapbox, Jeb. What we are doing is going way off script, but I think this is valuable for anyone listening at home because there's a couple of things that come into play. Have someone that will be closing a loan for this week. We went through it and he says, I'm not really a gambler. He could afford to float it, makes plenty of money, very low debt to income ratio, buying well below their means. But he said, no, I'm more comfortable locking it. Then 2 weeks into it says, hey, I'm looking at my credit union and they can do this. They go, okay, I can do that too if we lock today, but we locked 2 weeks ago. You got that insurance. So we're going to go into the potential for a float down, and we're actually that borrower. We're 2 days away from closing, and we're considering asking for a delayed closing. So we might be able to do a float down. Not guaranteed, but we're in the range of where he may be eligible for a float down. Going back to I'm getting 2 different quotes. I get a quote from this person, and then 2 weeks later, I get a better quote, and I go back and allow the first one, or 2 days later, or 2 hours later, and go back and give the first person. The one that I see more often, Jeb, is someone is in process with someone, and they call up and they go, these rates are awful. Shouldn't I be getting a better rate than this? And we go through and we go, and I'm not saying, hey, yeah, I can beat their rate and I'll make half my normal commission and I'll be okay with that. I mean, our normal margins are significantly better. And they'll go back and go, okay, this is terrible. I'm going to call the guy and tell him I'm not going to do the loan with them, and I'll get back with you tomorrow. And I call back tomorrow. Hey, I called my guy, and it's funny. It's my guy. It's not the guy. It's my guy who was screwing me yesterday. And yeah, he looked at your numbers, and he's going to do that for us too. And it's like, okay, that's wild. And I guess sort of the last example there, we had a listener to the show here about 6-8 weeks ago down in Florida. She was getting 7.5 on a VA loan. This is a veteran, and veterans often get some of the worst pricing, or there are some lenders out there the furthest.
But they shouldn't be getting the worst pricing.
They shouldn't.
Right.
They should be getting really good pricing. For whatever reason, many lenders go the other direction with it. So we look at it. She's at 7.5. I go, okay, we can get you 6.875 with 0 points. They're at 7.5 with it was less than a half of a point, but they were charging something for 7.5. We're 0 points at 6.875. Well, in this instance, I didn't disagree with her decision. She tells me on Friday, yep, we're going to go with you. I'm going to let them know over the weekend. On Monday, they call back and they go, okay, I went through it with the other lender. They did improve the numbers a little bit, but when I looked at it, I'm only buying a $215,000 house. It was like a $55 difference in the monthly payment. So that's real money, right? If you're buying a $200,000 house, you don't have an extra $55 in your budget, but they were like 2 weeks out from closing. So it's like, do I upset the apple cart, make a possibly delayed closing? So this is why it is important that you have these discussions up front and you do the rate shopping right, and that you understand that there's a commitment on your part also when you lock that rate. So kind of getting back to your question, is there a cost to lock the interest rate? A normal short-term lock, less than 90 days, there should not be an upfront cost. If you're in new construction and you need a 180-day lock, sometimes there's an upfront cost, but it's not an additional cost to the transaction. Think of it as like some high-end restaurants. If you make a reservation, they take your credit card and they say, if you no-show, we're charging your credit card. That's essentially what it is. If you ghost us, you disappear and you don't close, we had the cost of hedging your rate lock in the secondary market. That's a real cost to us. So if you don't close, we're keeping your money. But if you close, we're going to credit that to you. It's not an additional cost. It's already rolled into your transaction.
No, good stuff. And perfect segue into, if you're out there shopping, trying to get a pre-approval, looking for a second opinion, not sure about your rate, and you want to work with Josh and our team here, there's a referral link in the description of this video where you can get in touch with Josh. Doesn't mean you have to go with him. Doesn't mean you have to go with any of our team. It's just, getting a second opinion and making sure you're getting good numbers, you're solid, you feel like you're getting the deal that you should be getting. And, I hear Josh on the phone all the time telling people, hey, no, what they're quoting you is actually a good deal. That's a good deal. I would move forward with it. So it's not all, hey, just give us your business. It's, hey, yeah, that's a good opportunity for you, or no, you're getting not necessarily screwed, but there's a better opportunity for you. So if you want us to help, would like us to help, we would love that opportunity. Check that referral link. Now, Josh, I want to go transition into the question that probably comes up more often than any other question, and that's when. When can you actually lock a rate?
So let's go. There's two portions of that. When can I? What's the earliest I can lock my rate? And then the flip side, I get this sometimes. When do I have to lock my rate? What's the latest? And those are the people that are hitting the slot machine in the airport, but when they get off the plane in Vegas, those people want to know how long can I wager? How long can I be in the game before I have to commit to something? But when can you lock? Most times you have to have on a purchase, we're talking here, you have to have a property under contract. On a refinance, anytime you say, hey, Josh, I'm refinancing with you. Jeb, I'm refinancing with you. Jane, I'm refinancing with you. They can lock that interest rate at any time. On a purchase, most times you're going to have a property. The lock is tied to your social security number and the address. Now, there are lock and shop options out there. They are not popular because generally they have worse pricing. You have a very uncertain hedge in terms of when is that person going to find the home and close. And they also have a much lower pull-through rate. Like we talked about, some lenders having that upfront charge. No one does that on the lock and shop, but their pull-through is so low, their hedging costs in the secondary market, it impacts their margins so much that the lenders that do that generally have worse pricing. So do we have it available? Do we have investors that offer it? Yes, you can lock and shop with just you and your application and your loan program and not having a property. But 99 times out of 100, probably more than that, it is done once you have a property under contract.
All right. And this takes us into what happens if rates actually improve and you've locked your rate. This is probably the second biggest question, if not right up there at the first.
So let's use that example of the gentleman that I got to run the numbers here as soon as we get off. A lender has a cost for hedging that loan. So that's why they want you to honor that rate lock. But let's say it's extreme and you lock in a 7% interest rate. And by the time you get to closing, rates are 5%. The lender knows I have the hedging costs. I've already hedged that lock. So if the person goes, I'm going to Joe's Loans across the street and getting that 5%, they don't get to make anything. So they will offer a renegotiation that gives you the majority of that or much of that improvement, but not all of that. In general, like the most friendly options I have require you to move down at least an eighth in rate. Most require rates to move at least 0.25%. And there's a cost to doing that. So let's say that rates when you lock are 7.25%, and today they're 7%. And you go, hey, it's dropped a quarter, right? Well, it was 7.25% at 0. Today is 7% at 0. But they charge anywhere. Lenders will charge anywhere from 37 basis points, 50 basis points, some of them 100 basis points. So a 0.38 to 1 point to do that renegotiation for you. So generally rates are going to need to move, even under the best of circumstances, more than 0.25%, and you're going to get some, but not all of that move. Now, if rates move 1%, you're going to get 80% of it. If rates move 3/8, you're going to get about half of it. So the more rates move, the more of the benefit you receive. But the good news is you benefited from not having to worry about rates going higher. And even though you were wrong on the decision to lock, you're going to get most of the benefit of rates improving. So,
Josh, that's not how borrowers typically see it, though.
No,
borrowers typically see it as rates went down. I should be able to get that. It is what it is. Like, I took the hedge, I screwed up, but still I want my cake and I want to eat it as well.
I want to know that rates are not going to go up, but if they get better, I want 100% of that. Probably the best example, another listener of the show, very awesome borrower. Love her, had a great experience with her. She was actually doing a refinance for her mother with dementia, which brings very significant complications. As a result, this loan took more than 90 days and rates went down, then back up, and then back down throughout the process. And she just couldn't understand how the lock meant anything. The lock means it doesn't get worse, right? I can get better if it gets better. And that's a lot of people's understanding. So hopefully your loan officer is explaining to you up front what this means. Most people get that. The gentleman I'm talking to here, he knows, he understands. He's watching the credit union just because that's a good proxy for him. He knows our terms were similar to theirs. So he, instead of asking me every day, what are rates doing? He looks at theirs and he's like, okay, well, it's this much better. Is that enough for us to trigger that float down or renegotiation? So remember, it never feels good to not pick the absolute lowest day to lock your interest rate, but that is very unlikely. So work with pros, take their advice, know yourself, know your situation, make the best decisions, and know that you'll always or most times be protected by a float down policy. And you want to cover that with the lender before you decide with them to lock in the interest rate.
All right, let's transition into what happens once you've locked your loan. Purchase takes a little bit longer than expected because of whatever delays. We can make up a number of things that could happen, but the rate lock is getting ready to expire or does expire. What happens in that situation? Can you let your rate lock expire and take advantage of a better rate? I guess is another way to put it.
So you asked three really good questions there. So let's talk about the first one. What happens if my lock is going to expire? Let's say that the seller didn't let the appraiser in for 2 weeks, so we're delayed in closing. It's not your fault. It's not my fault. It's the seller's fault. We need a 2-week extension. Generally, 14 days is going to cost us anywhere from a quarter point to a half point. You and your agent can negotiate with the seller and say, hey, you cost us a delay here. Will you pay for the cost of that
No,
extension?
screw you. It's your problem.
So the reality is I will generally work with the buyer if they're in a bad spot. Not my fault either, but we can absorb some of that. You're going to pay some of that. I'm not going to absorb all of it because we didn't cause that. But let's say someone on my team drops the ball. They never ordered the appraisal and we're getting ready to go to docs. We're like, wait, we don't have an appraisal. This would never happen. It couldn't happen, would never happen. But somehow we dropped the ball horrifically. We're going to eat the cost of that. Now, if you're dealing with a broker, we're not going to talk about the sort of guidelines and mechanisms of lender paid compensation, borrower paid compensation. That can be harder for them to absorb that cost, but they will. And I will tell you, many of our investors, the people that we lock our loans with, that we end up closing and selling our loans to, if we get to 2 days, 5 days, 7 days, they can do a free extension, especially if the market has been stable or improved. So now let's look at it. Let's say you didn't pay attention that on your loan estimate, your lock expired on May 7th. Your loan officer is asleep at the wheel, doesn't notice that your lock expired on May 7th. Now what are our options? We have to relock that loan. At closing, your loan has to be relocked. And I guess we should probably revisit. We didn't talk about when does it have to be locked. When your closing disclosure goes out, we have to have your interest rate locked. That has to go out 3 days prior to consummation, which is a fancy word for signing your loan documents. So with all that, we do have to have it locked. So we would have to relock the loan. Now, again, because there's a hedge cost and because that lock was broken, if pricing is better, you're going to be able to relock, but there's a cost to that because your relock gets you a new 30 days, right? They're not going to give that to you for free. There's a small cost, anywhere from an eighth to a quarter point to relock, even if pricing has gotten better. Now, if the pricing has gotten worse, you're going to get worst case pricing. It's basically a new lock at current market. So blowing through that lock is not what you want to do. Your loan officer needs to be managing that lock, talking with you. Were you the cause of the delay? You didn't reply to any emails. You didn't sign your closing disclosure. You didn't get any of your docs back. Was the seller the problem? Figuring out what that is and who's going to cover the cost of that extension. So preferably you've extended early before it expires. If it expires, you can extend at a relock at a cost or worst case in the market. Now you asked another question. What if the rates are a ton better? Well, if the rates are a ton better, I can't just let it expire and relock the next day. Lenders know this. Again, they have a hedging cost. They've worked this. So most of them require your lock to be expired for 30 days before you can relock at current market with no cost. So really, you're looking at that situation. If the market's improved a lot, it's going to be a renegotiation. Again, we're going to go back through the renegotiation, go down to market because the rates improved a lot, but there's going to be a little cost to that. We don't just get to let it expire for 1 day and improve. And I got a real life example of a listener to the show right now that we're doing their loan. Some complications. He's self-employed. There's some moving parts with the refinance, and we needed to extend. We made the decision to let it expire because with that lender, it was a 0.10 or 1/10 of a point, 0.1% cost to relock. The pricing was about the same. It was marginally better. We don't get the marginally better because it doesn't qualify for the renegotiation. But for 0.1, we got a full new 30 days. We needed about 10 days. To get the 10 days, it was 0.02 a day. It would have been 0.2% to lock. So that's what your loan officer is doing on the back end. If we get into a situation where a lock is required, it's complex. You shouldn't need to know that. But if you get to the far end of a lock, your loan officer should be able to walk you through what's happened in the market. Are we better or worse? What are our options? Do we extend? Do we let it expire? Do we renegotiate?
All right. So how do you know, Josh, if your loan is actually locked? Because oftentimes somebody will call and say, hey, I talked to my guy and they're quoted a rate. Some people believe that because they were quoted a rate, that their rate is now locked, that is their rate. Obviously, huge misconception there. You've actually got to have the conversation about locking your rate, or that's the way that it should go. You shouldn't know that you shouldn't find out your rate's locked and never have said, I want to lock my rate. And on the flip side, if you've never had the conversation or you have had the conversation, then you need a way to prove it. So what is that way? How does that look like? How do I know so I have something to compare it to if that's what I'm doing.
A prudent lender should have you sign a lock-in agreement that says the terms, you lock this rate through this date at this cost on this program.
Mm-hmm.
If they don't, which I'm not sure if that's federal law, but I know the part that is federal law, when we go from floating to locking, a new loan estimate has to go out. On page 1 of your loan estimate, at the top of the very most important details, it says locked, not locked. So it'll say the rate is locked through this date and the terms on that loan estimate are accurate. So safest bet is to make sure you get your locked loan estimate. They should be able to get that to you within 24 hours. Now, if you lock, let's say Jeb sends me over a purchase contract. I call Susie. Susie, congratulations. Do you want to lock this? Before I even send out the initial loan estimate, now we have the contract. We have all of the elements. We have to issue a loan estimate. We can lock it right there. And so you don't get the initial loan estimate that says it's not locked and then a follow-up loan estimate that says it's locked. Your initial loan estimate with your disclosures will say that it's locked. So when you get your initial disclosures, if you look at your loan estimate, it says locked and you never had that discussion with your loan officer, probably the time to pick up that conversation and say, hey, I never said I wanted to lock this thing. Mm-hmm. Or maybe you told them very early on in the process, I'm not that person. I'm not going to make that decision. So lock it whenever you think is prudent.
So Josh, back in my day, prior to Dodd-Frank coming in, I actually did a little bit of mortgages after Dodd-Frank. But before that, there was obviously a lot of bait and switching out there. A lender, you would have a conversation with a lender and they would say, hey, your rate is 7%. And then you get to the closing table and your rate's 7.5 and you got to pay a point, right? So there's this idea that things could change at that time from what you were initially quoted. So once your rate is locked in, once you've been told it's locked, Josh, can that rate actually change from that period to when you're actually closing on the loan?
So this is one of the great elements of Dodd-Frank and TRID, the TILA-RESPA integrated disclosure guidelines, is there's no more of that. A loan officer has to issue you that loan estimate within 72 hours of any triggering event. It has to say whether you're locking or floating, and it has to say the terms of that. So with very limited tolerances can that change. Your rate, the charge for the rate, any charges to the lender, the broker, those cannot change unless something changes with your loan program. So what are the things that are most likely to change? Something happens, undisclosed debt monitoring comes up, your credit report expires, we have to pull a new one and your credit score drops. That can change the pricing. That's a valid change of circumstance. Probably the big one, it doesn't happen often, but it probably happens more often than a credit score changing throughout the process, is an appraisal comes in low. So the loan to value changes. If you were to change loan programs, if you lock on an FHA loan and you say, hey, grandma said she's going to give me 20% down, we want to go conventional, that's a different lock. 90% of lenders are going to reprice to current market when we go from FHA to conventional. If you go from a jumbo to a conventional, if it's a different loan program, that's a trigger. So you have to close on the terms without anything changing significantly in your scenario on that locked loan.
All right, Josh, we're going to wrap this up with a question that just came to mind that's not on the script here. But what happens if I lock in my loan, I'm in the process, I've got a property, everything is good to go, and the property falls through. But I've locked in the really good rate. Like that's the rate that I want. And the market changes during that period of time. I've got to go out and find a new property. Am I able to extend that lock to the new property, or does the entire process start over?
I would say 9 times out of 10, you will not be able to transfer it. I will say that I've had a situation where an investor has allowed us to transfer a lock. They want to close the loan. And in the reality, there's no such thing as a rate lock in the real world. The investor that's going to own your loan doesn't get to go and say, hey, we're pushing a button. We get to input your information, push a button, and we get a lock confirmation. That's basically telling their capital markets desk, we have this much production coming in. We have to hedge this much in this way. So they can do that. Most of them will not. But it's definitely, if you don't ask, the answer is always no. So if that situation comes up, ask. But let's say you're 15 days into a transaction and you've locked an amazing interest rate and it falls out. And then a week later, so now your 30-day lock, there's like 7-8 days left on it, and you find another property, and that's going to be a 60-day escrow. very unlikely that someone's going to allow you to transfer the lock to a new property, extend it out 60 days. They're going to say, hey, if you can get us close to the time period of the original lock with a very similar price transaction, very similar loan program, we might work with you. But we'll more likely than not, you won't be able to use the original lock.
All right, good stuff. I want to wrap up one more time saying if you're in the process, shopping, you're already, found a property, shopping around, want to work with Josh, want to just get a second quote, there's a referral link in the description of this video to reach out to us so that we can connect. And let us know in the comments, do you like videos like this? What else do you want us to cover? It's very helpful, when it comes from you guys, because then we know we're actually hitting the mark and covering the stuff that you want. And last thing I'll request is that if you haven't subscribed to the channel, do so by clicking that little button there in the corner, because not only does it show us that you appreciate the content, it helps support the channel and the work that we do here. So Josh, throwing it your way to wrap it up.
There was one question that you asked that we didn't answer. Can I lock with two different lenders? You shouldn't. There's a cost to both of them. You shouldn't be wasting anyone's time. And the real question behind that question is, can I double app? Can I put an application in with two lenders in case one of these clowns drops the ball? There's nothing preventing you from doing it. If you want to do that, you should ask both loan officers, hey, this is what I want to do. Are you cool with this? If you ask me that, I'm going to tell you no. I am committing to doing my job and getting all the way to the finish line, and I don't get paid until your loan closes. Literally not one dime comes to me until your loan closes. So you're saying, hey, coin toss, 50-50 chance, but put your best foot forward. You might get paid at the end of having done your job. We're not going to do that. So there's a cost to the lock. There is a cost in time, effort, and energy to work on that loan. So if you think that's something you want to do, just please don't do it undercover and not tell anyone. And then a day before closing go, hey, I'm sorry, we got here to closing, but I actually got better terms with the other lender that I also had working on my loan. Have the conversation up front, do your shopping, get rate quotes on the same day for the same lock term, for the same loan program. Make sure you're working with someone, as we always say, that you communicate well with, get along well with, that returns your calls, that's knowledgeable, has expertise, is professional, and has good terms. Yeah, you should be able to make that decision up front, right, Jeb?
Absolutely. And just like anybody we do business with wants us to be honest, wants us to be transparent, wants us to be ethical, it's also required of the client as well, the consumer as well. I mean, you should be the same things that you're requesting of us to us, so that we can all get to the finish line and know exactly what's going to happen. So with that said, guys, we appreciate the continued support. We appreciate all the comments, the emails, reaching out. If you do have additional questions, you can reach out to us. We welcome it. But until next time, adios.
Amigos.